Hello, everybody. My name is Andrew Schwartz. I'm partners with my brother Rick Schwartz in the CPA firm of Schwartz & Schwartz. We're based north of Boston in Woburn, Massachusetts. Each winter, we prepare a little bit more than a couple thousand personal tax returns. 90% of those are for physicians, dentists, and psychologists. The rest of the year, we work with about 350 one and two owner medical and dental practices. So we're very familiar with the issues affecting people in the healthcare community, the tax issues, and we're going to go over some of those matters right now. So I've done this webinar for the last 3 or 4 years, I think, and we tinker with it a little bit every year. But I hope you find the information informative, and let's see what we're going to talk about. Okay, so today we are going to touch base again on the PPP loans. Those have finally come to an end. But we'll talk about those. Then we'll talk about deductions that are common to healthcare professionals and people who are in the locums field. We'll talk about retirement accounts, which are the best tax shelters available to working people. Health savings account, which are the only place where you can make tax deductible contributions that grow tax deferred that you can take out tax free, but we will go over that again. Then we'll talk about paying your taxes when you get paid as a 1099 contractor, the new qualified business income rules, and last but not least, we'll talk about planning. And we have up to an hour set aside to go over these topics. It'll probably be shorter than that. Okay. And I'll try to look at the Q&A every once in a while. Okay, so it's been a crazy couple of years, starting about 2 years ago. The whole virus started in China and places like that, and we started to hear more and more about it. And then, unfortunately, it came over here, and it affected us all. Everybody who was in business, everybody in healthcare, it affected us immensely. So, and businesses were in trouble. Nobody knew what was going to happen. People were stuck in their houses. So the government acted very quickly, and by doing so, they came up with the Paycheck Protection Program loans. And the first ones came out in early April, and it went into the summer. What they did was excellent. It kept a lot of businesses in business. It really stabilized things. But that was more of a 2020 issue. The money went out, as I said, in the spring of 2020. You had 24 weeks to spend the PPP money. Anybody who had employees or self-employed people or people who only had themselves, or businesses that only had themselves on payroll, were eligible for a PPP loan. So most healthcare providers got it, and PPP 1, it came earlier in 2020, and the forgiveness was done by the end of 2020. So it was mainly a 2020 issue. Okay, and then they came up with the second round of PPP, and this, you had to reach a certain threshold to be eligible for the second round of the PPP loan. And these loans, these loans were created the end of 2020, and they were granted early in 2021. But to be eligible in any calendar quarter during 2020, if your revenue went down by more than 25% from the same quarter of 2019, you were eligible for the PPP loan. The same thing if it was only you who was on payroll of your business, or if you were self-employed and earned more than $100,000, then you were eligible for a PPP loan of $20,833. Those loans, the forgiveness period started 24 weeks after that money after those loans were granted. And so some people started to get the loans forgiven later in 2021, and some people still need to do it. If you got a PPP 2 loan that you want to get forgiven, the window to get that loan forgiven is closing. You actually have 2 years from the time you got the loan to get it forgiven, but you're gonna have to start making payments on it. So if you got a PPP 2 loan and you didn't go through the process with your lender to get it forgiven, I would suggest that you do that pretty soon. It's a very easy process, especially if you got less than $150,000. Now, for the longest time during 2020, we were under the assumption that anybody who got a PPP loan, the expenses paid with the PPP loan would not be deductible. That was how we thought it was going to be all during 2020 until the very end when Trump signed his stimulus package into law, and the rules changed very quickly. and all of a sudden, the PPP loan that you got wouldn't be taxable if you used it for the right purposes, and the expenses paid with the PPP loan was still deductible. So it was a great windfall for small business owners. So when you do your 2021 tax return, if you got your PPP2 loan, just remember not to include the PPP2 loan proceeds as part of your income, but include the expenses paid with the PPP2 loan as expenses. Okay, so that was pretty straightforward, and I have a feeling that we're not going to see round 3. The government gave out a lot of money and they really stabilized the small businesses, but we have to, there's just no more money to give out, frankly. There wasn't the money to give out originally, but there's definitely not any more money to give out. Okay. Okay. So I just looked at the questions real quick. If you're having problems with the, I guess some people are having a problem with the echo. If you can just put something in the chat or in the Q&A, so we're aware of that, that'll be helpful. Okay. So moving on from the PPP loan. So let's talk about the basics of being paid as an independent contractor. So when you do your locums, and if you do it through a company like Barton, they pay their locum tenens as an independent contractor. So you are not a W-2 employee. You are paid as a 1099 contractor, which means you have a lot of flexibility to do things, to save some taxes, to invest for your future and stuff like that. And we're going to go over some of those options right now. So the first rule is when you're compensated as an independent contractor, you're allowed to deduct your expenses that are both ordinary and necessary in connection with your profession. So as long as it's not, as long as you purchase something that you need to work in the profession that's not extravagant, that would be deductible. So a laptop computer that you use to keep your schedule, do your emails, do some other administrative functions, that would be deductible. The Gucci carrying case for your laptop computer, you might think that's ordinary and necessary, but under audit, I would assume that the IRS would disagree. And we're going to go over some of the stuff that is both ordinary and necessary for a locum tenens person. Okay. And very important, if you incur an expense that you are reimbursed for, that would not be deductible to you because you essentially didn't pay for it. And the expenses that we're going to go over are health insurance, travel, lodging, and meals, automobile expenses, education, licenses, and examinations. And in 2020, they came up with the Section 139 reimbursement situation, which in 2021 is a lot less relevant. Okay, so we're going to go and we're going to take a closer look at all of these items. All right, so let's start. I can move this. Let's start with health insurance. So basically, if you work for a company, the company provides you with health insurance. The company gets a deduction for the health insurance that they pay, and if you pay for some of the premiums with pre-tax dollars, that's how you get a deduction for your health insurance. When you're self-employed, you have the opportunity to deduct the full amount of your health insurance premiums as long as you don't have access to health insurance through another employer or through your spouse's employer. Okay, so if you're locum tenens, you have your own thing going on, and you're required to pay health insurance because you need health insurance. That health insurance is fully deductible. If you're later on in your career and you're over 65 and you're paying for Medicare, Medicare counts as health insurance, as deductible health insurance if you're self-employed. Okay, so if you pay health insurance, 100% of it is deductible, and you want to make sure to deduct 100% of your health insurance. And I put in here how you cannot deduct health insurance if your spouse has access or if you have access to another plan. Okay. Okay, the next expense I want to look at is travel, lodging, and meals. Okay, so the rule is based on whether you're working outside of the general vicinity of where you're living. So anytime that you take a job assignment for a year or less, that's outside the general vicinity of where you live, that whole time you're on that temporary job assignment, all the travel, lodging, and meals are fully deductible to you. Okay, so so outside the general vicinity of where you live means if you drive or if you travel there during the day, you would need to rest before you return. So if you live in a state that you live in one metropolitan area and it's a 3-hour drive to another metropolitan area, I don't know. That's probably outside. If you say there's a city that's 45 minutes away from where you live, I would say that's not outside the general vicinity of where you live. You can drive there during the day, do your work, and come home without needing to sleep before you return home. So if you meet that threshold, you're able to deduct 100% of your travel expenses, 100% of your lodging expenses, and then for this year, 2021 and 2022, as an incentive to get people to go eat at restaurants, you can also deduct 100% of the cost of the meals incurred while you're away. Okay, so that's great. Obviously, anything that you reimburse for, you can't deduct. But if you travel outside the general vicinity of where you live, travel, lodging, and meals. Now, for your meals, there are two ways that you can claim the deduction. One is you base the deduction on the actual expenses incurred. So you either use a separate credit card or somehow you keep track of all the meals that you paid for during the course of your temporary job assignment, and you base the deduction on the actual costs incurred. The other method is to use this method called the per diem rates. And the per diem rates, let's see if this works. It's right here. If you click on gsa.gov, let's put it on the right screen. You come here, and right down here, I thought I saw the per diem rates. Let's see. It has to be here. Oh, per diem lookup. Thank you. Okay. So you choose a location. Let's say you went to California. You went to California, and you want to search. I should have done this before. Anyways, you put in here, and you I will do my location. Okay. Oh, brother. Okay, too confusing. Sorry about this, everybody. You click on here, and you look up the per diem rate for the city where you are traveling, and you multiply the days you're in that city by the daily rate on that website, which if you spend more than 30 seconds on it, you'd find the rates. It's as easy as that. Now, the rule is you need to be consistent by trip. So you can do one trip during the year where you can base your deduction on the actual expenses incurred. And then you can do a second trip during the year where you base the deductions on the actual expenses incurred. And the second one based on per diem rates. And if you travel outside the country, there's a link right here for where you would find those per diem rates. Okay, so for 2020, 21, and 2022, meals are fully deductible, so that's great news. All right, let's talk about automobile expenses. So automobile expenses, the rules are as follows. Anytime you drive between job sites, drive to a temporary job site, or travel to interviews, conferences, things like that, those miles are all fully tax deductible. If you drive between your job, if you drive between your home in a regular job site, that isn't deductible. Now, a temporary job site is one where you work for a year or less. So if you use your car to go back and forth to where you do your locums, those miles are all tax deductible. And you can base your deduction either on the standard mileage rates, which is 56 cents a mile for 2021, increasing to 58.5 cents a mile for 2022. And all you do is you calculate how many miles you drove during the year, driving deductible miles, business miles, and you multiply it by that rate. The other option is you can base the deduction on actual expenses incurred times the percentage of miles driven during the year that are business miles. And actual expenses include gas, insurance, repairs, parking at home, lease payments if you lease the car, or if you own the car, you get to depreciate it. And a couple of years ago, they actually made the depreciation for an automobile pretty good. It was very low for a long time, but now owning a car isn't much worse or is equivalent to leasing a car for tax purposes. But the rule of thumb is, unless you drive very few miles during the year, with most of those miles being business miles, you're usually better off in the long run by claiming your deduction using the standard mileage rates. There is another loophole with cars, with vehicles out there, and I'm not sure if you've heard of it, but if you purchase a car that you use more than 50% for business, and you purchase one of those large SUVs or large automobiles that has a gross vehicle weight, a GVW, of more than 6,000 pounds, the regular limits for depreciation don't apply, and you're able to claim a huge amount of depreciation the year you buy that automobile. You do need to keep it in business use, more than 50% business use for 5 years, or you have to bring some of the depreciation back into income, and that's kind of administratively a pain in the neck. But if you're going to be doing this locums for a while, and you're making a lot of money, and you want one of those big cars, you're going to get a huge tax deduction by buying one of those large SUVs that weigh more than 6,000 pounds, fully loaded with you and your other people and your stuff. All right, so, but that's out there pretty good. And I think some of these electric cars, I think that heavy just with the batteries. I don't know. I really haven't looked at it. All right, but if you're driving in connection with your locums, somehow you want to keep track of the miles driven during the year, and that includes driving from your house to the place where you're doing the locums, and also driving around everywhere while you're there, not just driving to work. That all the miles while you're outside of the vicinity where you live is fully deductible. All right, so yeah, you can get a really big deduction that way. Okay. So now let's talk about education, licenses, and examinations. So here, the rules are as follows. Anytime you do something that qualifies you for a new trade or business, those expenses are not deductible. So that's medical school, law school, dental school. Those you need to go to those programs to meet the minimum requirement for profession. But once you're licensed in a profession, then all of the expenses incurred for continuing education, if you're taking college level courses, maybe you're taking your MPH or some other healthcare related coursework, your license renewals, your board renewals, those exam fees. If you need to get licensed in various states, all of those are deductible. The coursework to get you to the point to take your initial licensing isn't deductible. The initial licensing in theory isn't deductible. I know some people kind of get around it by saying that if they're in their training, they qualify for a limited license where they can work at the hospital, which means that's their first license. So when they pay to take their initial board exams, that's actually should be deductible because they're already licensed. I don't know. There's a lot of different ways to do it. We actually do use that philosophy here. So, but there's another thing that you want to come up with a way to keep track of all the continuing ed and the licensing and the coursework and everything that you're taking to improve your skills or maintain your skills in your current trade or business. Okay. So, but that's a good one. And you guys are all done with your training or anything, but and you're in a field where you travel to different places for a year or less. But if you're involved in a trade or business and you do coursework that has you go to a different city for a year or less, and you're there just studying, you're not even generating any income, but your intent is to return back home. Actually, no, if you go to a place for a year or less, and you're involved in some type of training program and you're getting paid a reduced amount of money, that year, that whole time that you're abroad counts just the same way as travel with a locum tenens. So just some stuff to think about. All righty. Okay, so the section 139 reimbursement, this started coming out last year because of all the expenses people incurred to be able to continue working during the beginning of the COVID crisis. All right, so this actually came out after September 11th, after those attacks, and basically it allows certain personal type expenses to be deductible to practice owners and to selected staff. So you probably don't have any staff. So it came out then because there was a lot of all of a sudden the world was upside down, and for people to continue working, they had to incur a lot of extra expenses. Well, this applied during the pandemic too. So if all of a sudden for you to be able to continue working in your field, you needed to incur certain costs, such as setting up or using your home office if you work remotely, purchasing technology or improving your internet at home to be able to work effectively remotely, or spending more money on childcare, or personally paying for education to enable you to work. All that stuff that would never be deductible before is now deductible as a business expense. So last year, we had a lot of our clients write themselves these 139 reimbursement checks to reimburse themselves for these personal expenses that they incurred. The reimbursement check would be deductible against the locum's income, or we'll talk about incorporating a little bit. So the 139 reimbursement, fully deductible against the locum's income. The 139 reimbursement is then not taxable to the recipient, which is you. So you essentially write a check from your business account to your personal account, note that it's a 139 reimbursement, and you would not be taxed on that. So in theory, the way things went this year, the whole COVID thing didn't go away. So think back or look at your records, and if you incurred any of these personal type expenses that generally wouldn't be deductible, but you needed to incur them so you could continue to work and generate income, then you probably have yourself a 139 reimbursement that you can go and write a check from your business account to your personal, little tax-free gift to yourself. But you have to capture the expenses that you paid, and you do want to document somehow what you reimbursed yourself for. You don't want to just write the check and then a couple of years later try to remember what you wrote the check for. All right, and we have a nice article on here. I believe this information, this slide deck will be available. So this is on my firm website, and this is the article that we wrote about that, and it was a good one. Okay, so I mentioned earlier at the beginning of the talk about retirement plans, and I said for people in their working years, contributing to a retirement plan is the best tax shelter available. And let's talk about why. So when you work for a company, the company you work for will set up a retirement plan and will give you access to a retirement plan, and that's basically your only option to save for retirement besides an individual retirement account, an IRA. When you're self-employed or when you have your own little corporation, it's up to you to set up the retirement plan. And we'll talk about the options in a minute. But I want to explain to you what makes these retirement plan contributions such a great tax shelter for people in their working years. All right, so let's say that you are in the 28% tax bracket. I actually don't even think there's a 28% tax bracket anymore, but the numbers work better. Let's say you're in the 28% federal tax bracket and you work in a state with a 5% tax bracket. So that puts your combined marginal tax rate at 33%. And let's say you want to put $1,000 away for retirement, and not in the version that's not deductible, not in the Roth version, that's different. Let's say you want to put $1,000 into your traditional retirement account. So if you put $1,000 in, you save $330 in taxes, right? You save $330, it says it right there. So it only costs you $670 in after-tax dollars for every $1,000 invested. So you already earned $330 on the 670 invested. You already earned a 44.25% return on your money, right? So you put in 1,000, the government gives you back 330, so it only really costs you 670. You got a 44% return. Now, of course, you're going to pay back those taxes later when you retire and start drawing money out of the account. The key is you get to keep the compounded earnings on that $330 for as long as the money stays invested. So when your money's in a taxable account, you have your capital gains or your interest or dividends. You earn that income, you pay the taxes, and you pay it right then. And so you have like less money to invest. In a tax deferred envelope, the tax savings stays in the envelope and continues to grow. And as I said just a couple seconds ago, you keep the compounded earnings on the tax savings that you pay back to the government way later when you retire. And that makes all the difference in the world. These things grow at a much quicker rate when there's no taxes involved than a regular taxable account. Okay, whoops. Okay, so you'll be taxed on the distributions you take, but you keep the compounded growth on as long as the money stays invested. Okay, if you're self-employed, the options for most people are either a SEP IRA, a simple IRA, or a solo 401k. And we do have a link, or we have a webinar, I recorded a webinar on that right here. But with a SEP IRA, and I'm not going to get that deep into it, depending on whether you set up an S corporation and pay yourself a salary, or if you're self-employed, you put away 20% of your self-employment income or 25% of your W-2 salary into a SEP IRA. So if you earn $100,000, you put away $20,000. With a simple IRA this year, you can put away $14,000 plus 3% of your income. So if you make $100,000, you would put away $17,000, right? $14,000. The first 14 you can put away plus 3% of your income. If you're 50 or older, you can do an extra $3,000. And a solo 401k this year, you can put away $20,500 plus 20% of your self-employment income or 25% of your W-2 if you're a corporation. So let's say you're unincorporated and you make $100,000, you'd be able to put away $40,500 into a solo 401k on the $100,000 you earn. It's huge. So if this is like, if you're married and your spouse has a good income and this is a second income and you're gonna make $100,000, you can put $40,000 away into a solo 401k pre-tax. Get a big tax deduction. It's a nest egg growing tax deferred. It's creditor protected. It's a great place to put some extra money. Or if you're later in your career and you need to catch up, you didn't put away enough retirement money over the years, a solo 401k is a way to catch up really quick. And there is even a more aggressive option that's called a defined benefit plan. And with a defined benefit plan, you can put away almost everything that you make pre-tax into a retirement account. But that you need to work with kind of a sophisticated financial planner. But there's options out there, and I strongly recommend that if you are being paid as a locum, you set something up early in the year, you put away money consistently throughout the year. It saves you taxes, it gives you some financial independence, creditor protected, it checks all the boxes. Okay, health savings account. As I said earlier, I should have said spoiler alert in front of it, but I forgot. Okay, the health savings account is the only place that I know of where you can put tax deductible money in that comes out tax-free later. So health insurance, anybody who's buying their own health insurance, I'm sure you'll agree that health insurance is very expensive and the benefits aren't that great, right? You pay every month. You go to the doctor or you go to the hospital, you do whatever, and you pay out of pocket for almost the whole thing at first until you have unfortunately paid a lot, and then it kicks in. So obviously they're doing that to control the costs or try to control the costs. So if you have a qualifying high deductible health insurance plan, okay, a qualifying one. And the only way to know if it's qualifying is you ask the health insurance company that you got your health insurance, and you ask whether this qualifies you to contribute money to a health savings account. So you get the high deductible health insurance plan, you pay the premiums, and then you have the opportunity to set up a separate account. This is an account and it's your money, and it's always your money. It's not like a flexible spending account that you can get from an employer that you set aside money every year pre-tax that has a use it or lose it component. A health savings account isn't that. A health savings account is a portable account which you put away money, and it's your money for as long as money's in there, okay? If you have a qualifying high deductible health insurance plan, you can set up a health savings account, and for 2022, you can put away $7,300 into a health savings account if you have a family plan, and you are an independent, and you could put away $3,650 into the health savings account if you have an individual plan. If you're 55 or older, you can add an extra $1,000. So the money that goes into the health savings account is pre-tax dollars. It's deductible. You get a tax deduction. The money that stays in the health savings account grows tax deferred. All the big financial institutions now have opened up to health savings accounts, so you can invest your health savings account at Vanguard, Fidelity, Schwab, through your financial advisor. Wherever you want to do it, you can invest it in whatever mutual funds you want. And then when you take out money later to pay for your family's healthcare costs, that money comes out tax-free. Okay, so it's a great deal. And any money sitting there after you turn 65, you can take out, and you don't pay an early withdrawal penalty, but you do pay taxes on the amount of money that you take out. I don't know anybody who's going to be that age who isn't going to have health costs to pay on their own. So I think that rule is kind of irrelevant. So I put in the amount that you can put away for 2021 and 2022. There's still time to put away money into your HSA for 2021. You have till April 15th to do it if you had a qualified high deductible health insurance plan in place. All right, and then the strategy that a lot of people use is they'll put money into the health savings account, and when their family has healthcare costs that they've incurred, they won't take money out of the health savings account. Instead, they'll pay for that out of their own personal checking account, and they'll just keep more money growing in this tax advantage envelope to use later when the health costs are probably going to increase, as all of us do for the most part as we age. All right, and then we have a nice link to an article there on how to on HSAs. Okay, quarterly taxes. So when you work for somebody, they withhold taxes. Hopefully they withhold enough. The withholding tables don't always work so good. And if you're wondering why they don't work good, it's for two reasons. First, if you're married and both you and your spouse work, and you both tell your employer that you're married, the withholding tables assume that your spouse doesn't work. So when you both work, and especially if you earn a similar amount of money, and you both tell your employer you're married, you most likely will not have enough taxes withheld, and you will owe money when you do your taxes. The other is if you work at multiple jobs at the same time, each job withholds as if they're your only job. So if you work at one job and make $20,000, if you work at three jobs and make $20,000 at each, they'll withhold a lot less in federal taxes than if you work at one job and make $60,000. It's just how the system works. If you're self-employed, you have to pay your own taxes by submitting these quarterly estimates. It is not difficult at all to do, except you have to remember to do it. No one is paying the taxes for you. So keep in mind that independent contractors, you're required to pay your estimated taxes on a quarterly basis. And if you're self-employed and you didn't incorporate, you also have to pay your Social Security and your Medicare taxes as part of your estimated taxes. So it's not just your federal income taxes that you're paying. You're paying this extra. It's a 15.3% tax on each dollar you earn up to like $140,000. So the taxes are high when you're self-employed, but you want to figure out how much you will need to pay each quarter. You do it through estimated taxes. You can either base it on what your taxes were last year, or you can base it on 90% of your current year's tax. And if you do either of those, you should not pay any underpayment penalties. If you don't pay any estimated taxes during the year, expect to pay an extra 2% to the government as an underpayment penalty, based on whatever. There are a few exceptions to factor in. All righty. Okay, this is the fourth year for the qualified business income deduction. This was a big deal when it came out because it was very new and nobody really knew how it worked. But essentially, if you're self-employed or if you have a flow-through entity like an S corporation or something like that, 20% of the income that you earn and you report on your tax return, not including your W-2 wages, qualifies as this QBI deduction. Which is great. So let's say you earn your $100,000, you're not incorporated, so you're a sole proprietor. The government is going to give you a 20% extra deduction based on this qualified business income deduction. So it started in 2018. It's available for sole proprietors, partnership, S corporations, limited liability companies. The problem is that the threshold where it's phased out for doctors and for other healthcare providers is pretty low. So if you're single, if you earn less than 165, if your total income's less than 165, you get the full QBI deduction. If your income's over 215, which is 165 plus 50, you get none of the QBI deduction. And then it phases out during that $50,000 window. For married couples, the phase out is 330. It starts and it ends at 430,000. So if you're married and your spouse doesn't work, or if you're just not doing this on a full-time basis, your income will be low enough to get the full QBI deduction. And it's nice for people who are S corporations. And I actually don't think I talked about it, but if I don't, I'll circle back on that, my philosophy on S corps. But if you're an S corporation, you do have to pay yourself reasonable salary, so the QBI would be based on just the leftover income that you report to yourself. Okay, so some planning tips to go over. First off, so I highly recommend that anybody who gets paid straight follows the 40% rule. And what that means is when you get paid, you put 40% into a separate bank account, and that is available to pay your taxes. The 60%, you can do whatever you want with that money. That money can be spent. If you put away 40% of your self-employment income or your self-employment income after being reduced by the expenses, you should have more than enough money to pay your taxes, maybe fund your retirement account a little bit extra, or fund an individual retirement account, an IRA. But if you don't put away the 40%, you're going to be scrambling come tax time to come up with the money to pay the taxes. And then it becomes this endless loop where you need to work extra to come up with the money to pay last year's taxes, and then you tax on that income, and you just never get off that wheel. Okay, the second thing, submit quarterly estimates. So you either base it on your prior year tax, or you base it on your current year tax. So a lot of people who do their own taxes on TurboTax will just put in what they think they're going to make this year and pay estimates based on that. All right. You definitely want to keep track of your expenses very well. And there's different ways to do that. The best way to do that is to use a personal finance program, such as, Quicken or Mint. And that will link up your credit card and your bank account with this program. You have to classify the different vendors at first, but once everything's set up, at the end of the year, you press a button and you get a report that lists all of your business expenses all in one place. It makes it so much easier than trying to remember all the money you spent over the years. And these are available online. There's other tools and apps out there where you can link your bank account and credit cards to a program. Another idea is to use a dedicated credit card only for your business-related purchases. At the end of the year, you hopefully it's one that gives you the nice year-end report that classifies everything for you, and you use that to calculate your taxes. But you got to be diligent to put all your business expenses on that credit card, and to not commingle personal expenses with business expenses. That just makes everything more difficult for anybody involved. We have a handy spreadsheet that you can use to track your expenses. Let's see if this works better than the other thing. Here it is. We put this out a long time ago. This is on our website, but you just put in what you spend each month. Oops, and it tallies. You got to download the file, but it tallies everything up automatically, and it gives you the right answers. It's an easy spreadsheet to use. There, okay, and yeah. So you find the method that works with you. The worst method is to keep your receipts, put those in a separate file, and tally those up at the end of the year. You can do better than that, but if you don't want to do any system, at least find somewhere to put your receipts and keep track of those. Okay. So you want to keep good records. Deducting your professional expenses against your income is one of the best ways to save taxes. You want to take advantage of the tax shelters we discussed, which are the retirement accounts and the health savings accounts. And frankly, you probably want to consult with a tax professional. The rules are complicated. The rules keep changing. And in the last 2 years, with all the stimulus money that was available to different healthcare providers, it was really a challenging year. I don't know how anybody who didn't have a CPA or a lawyer or a financial advisor who specialized in the healthcare field kept up with any of this stuff. It was, frankly, it was relentless. It just never ended. You guys, healthcare went above and beyond. So I'm not comparing the accounting world with that, but there were a lot of changes, and there was, and our clients really needed to lean on us a lot the last couple of years. But we were in the safety of our own office. So thank you for everybody for all the hard work that you did. I'm not minimizing that at all. Okay, so questions. I see a bunch of people did ask some questions. So let's see. Will there be an extension for quarterly taxes? I don't think so. I think there's no more extensions right now. So as far as I know, the due date is, it's not the 15th. It's a few days after the 15th, because I think the 15th is a Saturday. And then the, let's see. Yeah, January 15th is a Saturday. The 17th is Martin Luther King Day. So everything's due January 18th. I only work locum quarters in the fourth quarter. Big organizations first quarter. Can I still submit a 15.3% of what I earned for quarter four? Okay, so this is a very interesting question. So he's asking about the Social Security and Medicare taxes on his Locum Tenens 1099. So the way this tax works is actually the more you earn, the less you pay in taxes. So this is a regressive tax. So you pay Social Security taxes on only the first 140,000 or so of your salary, maybe 137.7. I actually don't remember, but it's about 140,000. So if you earned 140,000 as a W-2 employee as the first part of the year, you're not going to owe most of the 15.3% tax on the 1099 income. Okay, so when you work for a company, they withhold 6.2% for Social Security taxes and 1.45% for Medicare taxes. So that combines to be 7.65%. Your employer then matches the Social Security and Medicare taxes withheld. So the government gets 15.3 cents on every dollar you earned. If you're self-employed and you get a 1099 for being a contractor, the government still wants 15.3% of every dollar earned. And you pay that. That's a tax I was talking about before. You pay that as part of your federal income taxes each year. But in this situation, if you hit the $140,000 wages the first 2 quarters, you don't pay 12.4% of that tax for 2021. You'll start paying it in 2022, but for 2021, you hit the Social Security max and you're done paying the tax. So you might not even need to pay the 15.3% tax, but you probably owe some federal income taxes too, right? So when you earn 1099 income, you owe federal taxes on that income. You owe state taxes if you're the state where you either worked or live has income taxes. And then you also owe this extra 15.3% self-employment tax as part of your federal taxes. Do you have any tips on adjusting withholding on a W-4 for married couple? Yes. I would say the easiest thing to do is if there's a married couple, both spouses earn a similar amount of money, is for one of the spouses to withhold as if they are single. So in the old W-4, you had three options for marital for withholding status. It was single, married, and then the third option was married but withhold at the higher single rate. I think in the new W-4 they don't have that. But if one of you just withholds as if you're a single person and claims 0 allowances or 1 allowance, that usually does the trick. So people who claim to be married on the W-4 have less taxes withheld than somebody who is single. And then if people claim to have kids or more allowances, less taxes are withheld with each allowance that they claim. Does QBI come first and then the 15%? All right, so when you are self-employed, you pay this 15.3% self-employment tax. You do get to deduct half of the self-employment tax as an adjustment to income. So the QBI deduction is actually your net self-employment tax less half the self-employment tax. Wait, it's your self-employment income less half the self-employment tax, actually less your health insurance, less your retirement plan contributions, and that's the number that you times the 20% for the QBI. So the self-employment taxes deduction comes first. The actual self-employment tax comes later. And the self-employment taxes, if you're unincorporated, are not a deduction against the 1099 income. It shows up later on the tax return. Is QBI an automatic 20% deduction if married filing jointly makes less than 430? Yeah, whoever does your tax return, or if you do it on TurboTax, you just need to say that you have a business, and you need to indicate that you're a specialized service business. So you have to let them know that there are more limitations to you than a business that manufactures or distributes. But it should be automatic. Like, if not, a diagnostic should come up. Okay, a Medicare premiums deductible in 2021 tax, like the health insurance premium for self-employment getting at 1099. Yes, if you pay Medicare, and it's my understanding if you pay Medicare for a spouse, even if you don't get Medicare, all that is deductible as a health insurance deduction. And if you're self-employed, that's an adjustment to income. So it's not deductible on your Schedule C. It's not deductible on the form where you calculate your net self-employment income, but it is deductible on your tax return. If I was a staff provider during the September date, so I need to file quarterly for 118. Locum started 2022 with first income. No. So if you didn't earn any self-employment income, then you wouldn't pay any quarterly estimates until 2022. So if you earn money between January and March, you would pay the taxes on that income April 15th. The next quarter is only 2 months. So if you earn money in April or May, you pay June 15th. If you earn money July through August, you pay September 15th. And then if you earn money the rest of the year, you pay next January 15th. Provider would be able to deduct the spouse health insurance if the spouse is self-employment. Yeah. If the yes. Yeah. So if you work and you have to get, if you're self-employed or you're doing locums, you need to get your own health insurance, that's deductible. But it's not deductible if your spouse has access to health insurance. If your spouse doesn't have access, then it's definitely deductible. And it does include Medicare. The COBRA thing, I think in theory, no, but I generally take it. And my thinking on that is the COBRA is probably the most cost-effective way for you to get health insurance. So if you're self-employed and the health insurance you're getting is a continuation from the job you were working, I would take it. Premiums I pay to be covered under spouse's plan do not count. Yes. So if your spouse has access to a plan from work, those wouldn't count, and those should already be paid with pre-tax dollars through your spouse's employer, right? So when you work for somebody, unless it's a tiny company, any health insurance premiums that you pay personally are pre-tax. Okay, yeah. So those spouse, you include the family health insurance as a deduction. Oh, how does deducting work? How do you deduct expenses if you're employed and you do some locums? I don't know. I take the expenses that my clients incur against the 1099 contractor income or against the locums income. I won't show a loss, So you don't want to show a big loss. You don't want to show any loss because those are the tax returns that have the highest risk of being audited. But say you earn, I don't know, 100,000 as a W-2 employee and 50,000 as a locums, I would take the expenses against that 50,000 and feel fine doing that. Because 2 years ago, they got rid of the rule where now W-2 employees cannot deduct their unreimbursed professional expenses. So the only place to take it is against the 1099 locums. Can you save receipts from years of health related expenses and then submit the receipts? Yeah, I heard that. So he's asking about a health savings account. Remember, when money goes into a health savings account, it's pre-tax. When it comes out, it's tax-free. Somebody mentioned that to me recently. They said, I heard, and so I'm telling you something that I heard secondhand, that you can just accumulate your healthcare receipts, and then at the end of the year, and then way down in the future, you can take money out of the HSA to reimburse yourself. Yeah, you may want to Google that, but that's my understanding of the rules. So, and whether a PPO plan qualifies someone for a health savings account, I don't know. It has to be a qualifying high deductible health insurance plan, and the only way to know for sure is it either includes HSA eligible in the name of the plan, or ask the health insurance company. That they'll tell you. But there's very specific things that the health insurance plan needs to do to qualify someone to be able to open a health savings account. Is there a way to deduct flights purchased with frequent flyer points? No. The only way to do it is to pick up the value of the frequent flyer points as income, so it would be a wash anyways. You can use 100% based on per diem since I don't keep receipts. You sure can. So if you're somewhere for 100 days, and like you're in Chicago where I think the rate's $74, you get a $7,400 deduction, and you don't need to keep one receipt except for the dates you got there and the dates you left. Okay. My home residence is North Carolina. I came to Maryland for a 3-month assignment and rented an apartment. Sure, that's the cost of your travel. That's the lodging cost incurred during a job assignment that lasted for a year or less. So that apartment rental would definitely be deductible. You would probably pay the apartment right out of the account where you deposit the locum's income, your separate bank account. Can you do a combination of per diem rates and actual receipts? As I said during the talk, it has to be consistent by trip. So each locum's assignment, you have to do one way or the other. You can't, it's not week by week, it's by the whole trip. And don't forget, anytime you go somewhere for a year or less, the whole time you're there and going back and forth is seen as one long trip. Are meals reimbursed only for working days? No, I think that any day you're there, they count. A traveling lodging in an area far from where you live also deductible with a W-2. No, they got rid of the rule, as I said, when Trump made the tax law changes at the end of 2017, that rule disappeared. And now W-2 employees cannot deduct professional expenses. Can one also deduct travel, lodging, and meals to check on a new site? I would think so. That sounds to me to be ordinary and necessary. Is this section 168 or 179? Oh, what? Well, it's definitely not 179. So section 179 is when you buy equipment that you want to write off all in 1 year instead of depreciate over 5 years. I know. So 168, I think, is a business expense number. Can you deduct Lyft or Uber? Of course. Ordinary and necessary in connection with your trade or business. Deductions for automobiles used for house calls. Well, it matters how you paid, but if you paid as a 1099, that sounds like business miles. Barton reimburses for miles and lodging. Does that show up as income? You have to ask them. But if it does show up as income, you definitely want to write off expenses that were reimbursed. So let's say you made $100,000 and Barton gives you a 1099 for $111,000, which includes $11,000 of reimbursements. In that case, you need to put up $111,000 as income on your Schedule C or whatever form you're filling out. And then you're going to take a deduction of $11,000 and just call it reimbursed expenses in the 1099. So you need to report the full amount of the 1099 because the IRS is looking for it, but you only want to pay taxes on the income that you actually earned, and that's how you do that. Regarding auto expenses, mileage rates are just for a car you own and drive to a distant work location. A rental car, you would deduct the whole cost of the rental, which would be more expensive than 28 cents a mile, 56 cents a mile. So yeah, and you deduct, when you get a rental, you deduct the gas incurred and any other expenses associated with it. If I put travel expenses on my credit card at a job that I traveled for less than 12 months, then itemized costs and have the locums reimburse me. Now, if you get reimbursed, you can't deduct it. No, we just talked about that. The rental car, you can't use standard mileage on a rental car. You can use it on a leased vehicle if that's the only thing that you did from year one. If I buy a travel van, yeah, if you drive something like that, you get a lot more depreciation, but keep in mind, it has to be ordinary and necessary. So, does it make sense to buy a $150,000 RV to go work somewhere and earn, earn $100,000 and that's it? I don't know. So I would be concerned about whether buying an RV for locums is ordinary and necessary. If not, figure out how much you can deduct. Tips when you eat out included, of course they are. If you use the government rate for miles, can you deduct gas? No, it's either the standard mileage rate or the business use of gas, repairs, insurance, parking at home, lease payments if you lease a car, and then depreciation if you own it. Okay. The RV, it's tricky business, but I guess it would be a second home. Yeah, I'm not sure. I've never had, in my 35 years doing this, I haven't had up in the Northeast, RVs aren't as common, so I haven't really seen that. All right, so I think it's 5 o'clock. Oh boy.
Andrew, we can cover, I'm going to send all this out to everybody anyway. Everyone's going to get a copy of this recording, and then also the PowerPoint that Andrew went through, and any other tax guides or other documents that we have. And then Andrew and I can work on answering these questions. I tried to organize them, and I'll try to make sure I get everybody's comments and questions. I've been trying to keep up with them, but you guys are so involved. It's great. And then we'll send it out to you. But I would give Andrew maybe a few days to start answering some of these questions. Right, Andrew?
Yeah, I'll get to them. Yeah, this is good stuff.
Some of them are similar. Yeah.
I'll probably, if I do it, I'll give some to you. I'll probably post them on my website too. If I'm going to do it, I'll leverage it. Yeah,
make it a Q&A thing. Yeah, make a Q&A and kind of use this, because it seems like everyone has a lot of the same questions involving, especially health insurance, HSA, FSA, all that stuff, and then a lot of questions about the S corps. Yeah, so it's all right. I tried to group it, but I'll try to get everyone's questions, and then once we have the answers, we'll send them out to you guys.
All right, great. Well, I hope you found the presentation informative. I don't even know if do I have my contact information in here.
I think so, Andrew. Also, there was a question if you were currently accepting new clients for the 2021 tax season.
Sure. Yep. And I spoke to the person who works with me who takes calls from new clients and routes them to the experienced accountant. So yeah, my firm phone number is this 800-471-0045. My email, it's andrew@theschwartzaccountants.com. Yeah, so as I said, I've done this for a while, and we get calls from people. So if you have questions, feel free to email me. I do respond to my emails. It's a busy time now because we're trying to close all the books for our practice clients that we work with. So I mean, these Zoom meetings all day, but our goal is to be a good resource for the healthcare community, and that means people have questions, we want to be available to answer them. But yeah, I appreciate this opportunity. Every year, I know I talk fast and don't always enunciate so well and things like that, but I hope you got the gist of what I said, and I found this for the most part to be an informative presentation. So thank you.
This is great, Andrew. Thank you so much. See you again next year, Andrew.
Thanks. Talk to you later.
Goodbye, everyone.